If you were to step out today and walk through the commercial arteries of any major metropolis in the Western world, you would find yourself immediately confronted by a bizarre and deeply unsettling paradox. It is a contradiction so stark that it induces a form of societal vertigo. Cast your eyes upward to the digital displays in shop windows and the scrolling tickers on news terminals. There, the narrative is one of unbridled optimism. The mainstream financial channels are breathlessly reporting that equity markets are punching through all-time highs. They tell us that unemployment figures remain historically low and that gross domestic product, the holy grail of economists, is technically expanding. By every official metric, the system is thriving. But lower your gaze to the pavement, to the human reality flowing past those glowing screens, and you witness a completely divergent truth. You see the undeniable strain etched into the faces of the working class as they mentally calculate the cost of a simple lunch, a sandwich that now commands a price nearly double what it did just 3 short years ago. You see the commercial decay spreading like a fungal infection across our high streets, with for lease signs multiplying on storefronts that once housed thriving businesses. There is a pervasive, heavy sense of dread hanging in the air. A collective, unspoken intuition that despite the reassuring rhetoric from politicians and central bankers, the tectonic plates beneath our economic feet are fracturing. This is not merely negative sentiment. This cognitive dissonance, this widening abyss between the official economy enjoyed by the asset-holding elite and the lived economy endured by everyone else, is not an accident. It is the visible, festering symptom of a structural collapse that began nearly 2 decades ago. A collapse that was deliberately obfuscated by complex monetary engineering. Make no mistake, we are not simply navigating a routine recession. We are standing at the terminal point of a specific economic epoch. For 15 years, the global economy has been kept in a state of suspended animation. Kept alive only by artificial life support. It has been pumped full of synthetic adrenaline in the form of ultra-cheap debt and relentlessly printed currency. But now, the machines are failing, the patient is waking up, and the diagnosis is terminal. To comprehend why this unraveling is accelerating specifically now in the window of 2025 and 2026, we must look beyond the transient headlines about supply chain hiccups or geopolitical skirmishes. We must focus our attention on the single most critical price in the global ecosystem, the price of money itself. For the vast majority of human history, capital had a cost. If you wished to borrow resources to construct a factory, launch a venture, or purchase a home, you paid an interest rate. That rate was not arbitrary, it was a reflection of risk. It acted as a gravitational force, a filter that kept the economy tethered to physical reality. This mechanism ensured that only genuinely productive, profitable enterprises could survive. If a corporation could not generate sufficient profit to service the interest on its debt, it failed. Its assets were liquidated and sold to more competent operators. The economy evolved. This was the brutal but necessary mechanism of capitalist creative destruction. But in 2008, in the wreckage of the global financial crisis, the masters of the universe, the central bankers, made a fateful decision to shatter this mechanism. Paralyzed by the fear of a deflationary depression, the Federal Reserve, the European Central Bank, and their peers slashed interest rates to zero and in some perverse cases, below zero. This was the genesis of ZIRP, the zero interest rate policy era. It was sold to the public as a temporary emergency measure, a shot of morphine to stabilize a trauma patient through the night. But the emergency never ended. The morphine became a daily dietary staple. Instead of a temporary fix, it became a permanent lifestyle. For 15 years, money was effectively free. This profound distortion of value created what we now call the everything bubble. Because savers could no longer earn a yield by keeping capital in a safe bank account, trillions of dollars were forced out on the risk curve. Real estate valuations skyrocketed not because the utility of a house increased, but simply because the cost of the mortgage collapsed. The stock market completely decoupled from corporate earnings. Cryptocurrencies, some with zero tangible utility, ballooned into trillion-dollar asset classes purely on the back of excess liquidity. However, the most toxic side effect of this era was the evolution of a new, parasitic species of corporation, the zombie company. A zombie is technically defined as a business that generates just enough cash flow to keep the lights on and service the interest on its loans, but never enough to pay down the principal debt. In a functioning economy, these entities would face immediate extinction. But in the ZIRP era, natural selection was suspended. These failures didn't have to die, they could simply roll over their debt. When a loan matured, they would borrow new money at 1% interest to pay off the old debt. They became the economic undead, hoarding resources, labor, and capital while producing zero innovation or growth. By 2004, credible estimates suggested that nearly 20% of all corporate entities in the United States and Europe met this definition. They were ticking time bombs, stable only as long as the interest rate remained at zero. Then came the inflation shock of the early 2020s. The orgy of money printing unleashed during the pandemic finally broke the dam. Prices for energy, food, and shelter exploded upward. The central banks, realizing they had lost control of the narrative, were forced to slam on the monetary brakes. They hiked interest rates with a velocity not seen in 40 years. That was the moment the music stopped. The era of free money vanished overnight. And this is the critical point, the mountains of debt accumulated during that era did not vanish. Now, we are colliding with the maturity wall. Trillions of dollars in corporate debt and commercial real estate loans, originally taken out when rates were near zero, are coming due for repayment in 2025 and 2026. These loans must be refinanced. But the environment has changed violently. Instead of borrowing at 2, these companies are staring down the barrel of 6, 7, or even 8% interest rates. The arithmetic simply does not work. A zombie company that could barely tread water at 2% is rendered instantly insolvent at 7%. We are already witnessing the initial impact waves in the commercial real estate sector. Office towers that were valued at hundreds of millions of dollars just a few years ago are now changing hands for pennies on the dollar. Why? Because the owners cannot mathematically afford the new mortgage payments. This is the fundamental reason the economy feels like it is collapsing. Because the artificial mechanism that propped it up has been withdrawn. The perceived wealth created over the last decade was largely a valuation illusion driven by cheap credit. As that credit evaporates, valuations are violently collapsing back to reality. This shattering of valuation illusions is actually just wealth being redistributed at a macro level. The biggest challenge we're facing right now isn't finding the next stock to double in price. It's figuring out which assets are real and which are just bubbles blown up by cheap money in this unprecedented credit contraction cycle. I've put together a resource called the U.S. Stock Market Great Shuffling Operational Manual. It's not about predicting ups and downs. It's a framework that organizes the logic we just discussed into a practical reference you can use anytime. I've pinned the link in the comments. Go ahead and grab your copy. Pension funds that allocated heavily to real estate, banks that lent freely to zombies, and governments that budgeted based on tax revenues from asset bubbles. They are all waking up to find their balance sheets riddled with holes. The global economy is not just slowing down, it is detoxing from the greatest debt binge in recorded history. And like any biological detox, the withdrawal symptoms will be agonizing. The central banks are now trapped in a nightmare scenario. If they lower rates to save the zombies, inflation will roar back with a vengeance, destroying the currency. If they keep rates high to crush inflation, the zombies will die, dragging the entire banking system down with them. If the end of zero interest rates is the trigger, the ammunition is loaded in two specific sectors that are currently imploding in slow motion: Chinese real estate and Western commercial offices. These are the twin pillars of the global asset bubble, and they are crumbling simultaneously. Let us first examine China. For 20 years, China acted as the engine of global growth, consuming the world's steel, copper, and cement. But that growth was constructed on a Ponzi scheme of property development. In China, real estate is not merely a utility. It is the primary savings vehicle for the population. An astonishing 70% of Chinese household wealth is locked up in property. Mega developers like Evergrande and Country Garden pre-sold millions of apartments that did not yet exist. They used that incoming cash to acquire more land, while leveraging billions more from international banks. This cycle worked until prices stopped rising. Now, the bubble has burst. Millions of apartments sit as unfinished concrete shells. Developers are defaulting on their sovereign and corporate debts. The average Chinese citizen has watched their life savings evaporate. This has triggered a classic balance sheet recession. When people feel impoverished, they cease spending. Consequently, China is now exporting deflation to the rest of the world. In a desperate bid to keep factories running, they are dumping cheap electric vehicles, solar panels, and steel onto global markets. This crushes pricing power for manufacturers in Europe and America. The narrative of a China reopening saving the world was a mirage. The dragon is sick, and its sickness is highly contagious. Now, pivot to the United States and Europe. Here, the crisis is concentrated in commercial real estate cray. The pandemic permanently altered the topology of work. The shift to remote work didn't just empty offices. It destroyed the economic model of the skyscraper. In financial hubs like San Francisco, New York, and London, office vacancy rates have breached record highs. But the true magnitude of the crisis is hidden within the accounting ledgers. A building that was appraised at $500 million in 2019 might effectively be worth only $200 million today. However, as long as the owner doesn't sell it, the bank can pretend the loan is still performing at the old value. This strategy is known as extend and pretend. But in 2025 and 2026, time runs out, the loans mature, the owner must refinance. The bank will say, your collateral is now worth half of what you owe. You must pay us the difference in cash. The owner, unable to pay, will simply walk away. Keys are being mailed back to lenders across the country right now. This poses an existential threat to the banking system. But it is not the too-big-to-fail giants like JP Morgan that are in the immediate kill zone. It is the regional banks. These small and medium-sized institutions hold the vast majority of commercial real estate loans. When these loans go toxic, these banks will fail. We saw a preview of this movie in 2023 with the collapse of Silicon Valley Bank. But that was merely a tremor. The earthquake arrives when the $1.5 trillion maturity wall hits. The contagion effect is terrifying. If regional banks fail, small businesses lose access to credit. If small businesses cannot borrow, they cannot make payroll, and they fire workers. Unemployment spikes. Meanwhile, Western governments are in no position to execute a bailout. They are already running record deficits just to service the interest on their own sovereign debt. We are entering a doom loop where the banks own the government's debt treasuries, and the government guarantees the bank's deposits. If one falls, the other falls. The global economy is not collapsing due to a singular black swan event. It is collapsing because the collateral that underpins the entire financial system, real estate and government bonds, is simultaneously losing its value. So, what is the endgame? How will the authorities respond when this banking crisis goes global? They have one tool left in their arsenal. It isn't interest rates. It is total control. We must talk about the rise of central bank digital currencies (CBDCs) as the solution to this crisis. This is designed not to save you, but to trap capital within the system and force consumption. We have established that the economy is caught in a pincer movement. On one side, the everything bubble is deflating, threatening to wipe out zombies and real estate. On the other, the banking system is sitting on trillions in unrealized losses, too fragile to withstand the shock. In previous crises 2001, 2008, 2020, the playbook was simple: cut rates, print money. The central bank acted as the lender of last resort, but in 2025, that playbook is incinerated. Economists call this the trilemma. They cannot fight inflation, support the banking system, and fund the government deficit all at the same time. If they print money to save the banks like 2008, they reignite the inflation fire that is already gutting the middle class. If they keep rates high to kill inflation, they bankrupt the government, which cannot afford the interest payments, and crush the real estate market. They are completely out of ammunition, and when a government runs out of economic solutions, it inevitably turns to political ones. We are transitioning from the era of market management to the era of financial repression. The endgame is not a sudden, Mad Max-style collapse. It is a slow, suffocating tightening of the control grid. The authorities realize that the current global debt load, now exceeding $315 trillion, can never be paid back in honest money. It must be liquidated. Since they cannot default, which would destroy the system, and they cannot pay it, mathematically impossible, they must inflate it away while preventing you from escaping the burning building. This brings us to the most significant monetary shift since the creation of the Federal Reserve, the introduction of CBDCs. For years, CBDCs were marketed as a boring technical upgrade, just a way to make bank transfers faster. This is a lie. The digital dollar, the digital euro, or the digital pound is not money as you understand it. It is a surveillance and control tool disguised as currency. In our current banking system, if you lose faith in your bank, you have an exit. You can go to the ATM, withdraw cash, and store it under your mattress. This act, the bank run, is the market's mechanism for punishing bad banks. It is the ultimate check on power. With a CBD, physical cash is eliminated. You cannot withdraw your money. You can only move it to another digital wallet within the government's closed loop. This grants the central bank absolute power. Consider the implications if the economy is slowing and they need you to spend. They can implement negative interest rates. They can program your money to degrade by 1% per month. You are forced to spend it or lose it. If supply chains break and meat becomes scarce, they can program your wallet to allow the purchase of only 2 pounds of beef per week. This is programmable money. It transforms currency from a store of value into a system of social engineering. We are already seeing the soft launch of these controls. Look at the war on cash in Europe and Australia, where strict limits are placed on physical cash transactions. Look at the debanking phenomenon, where politicians and dissidents have their accounts closed for reputational reasons. The infrastructure for total financial control is being laid right now, under the guise of anti-money laundering and fighting terrorism. The collapse of the old economy provides the perfect pretext to introduce the new one. When the next banking crisis hits, likely triggered by the commercial real estate implosion we discussed, the government will not use taxpayer money to bail out the banks. That is too politically unpopular. Instead, they will bail in the system by forcing everyone onto the Fed's digital ledger. They will claim it is for your safety, to protect your deposits. In reality, it is to trap your capital. This shift fundamentally alters the psychology of investing. For 40 years, the goal was return on capital. How much profit can I make? In this new era, the goal is return off capital. Will I get my money back at all? The smart money, the billionaires, sovereign wealth funds, and family offices are already positioning themselves for this reality. They are aggressively accumulating hard assets. They are buying farmland. Bill Gates is now the largest private owner of farmland in the US. They are hoarding gold. Central banks are buying the metal at record rates. They are acquiring energy infrastructure. They are exiting the financialized economy of stocks and bonds and entering the real economy, the economy of things that cannot be printed. They understand that when the debt bubble finally bursts, the only assets that will retain value are those with physical utility and scarcity. The paper wealth of the middle class, the 401ks filled with overvalued tech stocks. The bonds paying yields lower than inflation will be the fuel burn to keep the system running a little longer. The global economy is effectively undergoing a great reset, but not the one conspiracy theorists scream about. It is a reset of valuations. The standard of living in the West, artificially inflated for decades by cheap goods from China and cheap debt from the Fed, is reverting to the mean. We are becoming poorer. But the headline numbers, GDP, the S&P 500, are being manipulated to mask the decline. The ultimate casualty of this collapse is trust. Trust in banks, trust in the currency, trust in the social contract. When that trust shatters, the economy doesn't just recede, it fragments. We are heading toward a world of parallel economies. One will be the official economy of CBDCs, taxes, and surveillance. The other will be the gray economy of barter, gold, crypto, and under-the-table labor. The window to prepare is closing rapidly. The maturity wall of 2025-2026 is the catalyst. The banking crisis is the mechanism, and the digital dollar is the trap. The question is not if it will happen, the math says it must. The question is, where will your wealth be located when the music stops? Will it be stuck in a digital token that the government can deactivate with a keystroke? Or will it be secured in something you actually own? We have discussed how the economic system is rigged to trap your wealth and inflate it away. But history teaches us that when a government becomes truly desperate, they don't always bother with subtle inflation or complex digital tricks. Sometimes they just kick down the door. In 1933, the United States government, the supposed land of the free, faced a banking collapse eerily similar to what we are witnessing today. To save the system, they decided they needed your money, specifically, your gold. Franklin D. Roosevelt signed Executive Order 6102. With the stroke of a pen, he made it a federal felony to own gold coins or bullion. He forced American citizens to surrender their life savings in exchange for paper money, which he immediately devalued. It was the largest state-sponsored theft in American history. What we are facing today is no longer a simple cyclical fluctuation. It is a systemic reset designed to dilute debt through financial repression and digitalization. In this survival race, where the logic of wealth is shifting from return on capital to return off capital, blind optimism is useless. What we need is the ability to see through these new rules of the game. That's why I compiled the US stock market Great Shuffling Operational Manual to help you map out a clear strategy for both defense and offense. The link is waiting for you in the comments. Click it to get started. You need to know if your safe is actually safe. I'll see you in the vault.